It may be August, but it feels like there's never really a quiet time for markets anymore. Unemployment and wage growth numbers on Tuesday the 12th, and then the first estimate for GDP growth in the second quarter on the 14th, will all give investors some insight into the UK economy's trajectory in the wake of the Bank of England's interest rate decision on the 7th. We also have a heavyweight lineup when it comes to company reports, with 7 members of the FTSE 100 scheduled to release first half results. They are Spirax and Entain on the 12th, Persimmon and Beazley on the 13th, and Aviva, Antofagasta and Admiral on the 14th. Of these, the house builder Persimmon may be particularly interesting for what it has to say about its own fortunes, those of its target market, and also the wider UK economy, especially as the Labour government continues to target deregulation for planning, building and lending for residential property as part of its growth programme. For all of that, however, Persimmon shares have crumbled over the past year. They've fallen by more than a quarter, despite healthy gains from the main headline indices. Input cost inflation remains an issue, as does housing affordability as interest rates come down only slowly, while the industry remains dogged by costs for fire safety and cladding remediation on historic projects. Taylor Wimpey's become the latest builder to set aside provisions here. Persimmon said little since its full year results in March, barring the announcement of the sale of Fibernest and a £15 million settlement with the Competition and Markets Authority. The York-based firm's already taken £275 million in fire safety provisions, so watch for updates there, as well as on forward-looking indicators like the £1.1 billion order book and the net private sales per outlook per week. Chief Executive Dean Finch flagged a 14% improvement to 0.67 for the first 9 weeks of this year. After that, analysts and investors will benchmark these first half figures and any updated outlook statement against full year guidance given back in the spring, where Mr Finch and the board have thus far steered expectations towards 11 to 11,500 completions this year, compared to just over 10,500 last year, when the average selling price was 268,000. In the first half of last year, completions were just under 4,500. He's also guided secondly to increased profit margins and profits. Analyst consensus is for an operating profit of 447 million for the full year, up from 369 million, helped by a 4% increase in sales in the absence of last year's exceptionals. That equates to a margin of 13.4% compared to 12.6%. In the first half, operating profit last year was 149 with an 11% margin. Attention then will switch to cash flow, the net cash pile, 259 million at the end of the year, and then the dividend. Persimmon distributed 20p a share to dividends in the first half of investors last year. Full year, small increase expected. Now, there are 2 other companies due to report in the coming week, and they may also offer insight on the wider economic cycle as well as their own specific fortunes. The first is recruitment group Page, which will release first half figures on the 12th. One, Pia Hayes has coughed up a profit warning in June, and another, Robert Walters, cancelled its interim dividend in July, as both flagged how the hope for uptick in trading had yet to materialise. That does at least set a low bar for Page, whose shares are at a 12-month low and trade no higher than they did in 2009. The key here is whether Chief Executive Nicholas Kirk sticks to guidance reiterated alongside June's trading update of operating profit of £22 million for the year, down from £52 million. The first half figure a year ago, by the way, was £28 million. Analysts expect an unchanged full-year dividend of 17.11p, so watch out for any change in the 5.36p dividend from half a year ago. Finally, we come to our third and final economically sensitive company, Derwent London, a real estate investment trust. Shares down by a fifth in the past year to levels last seen in 2012. Again, fears over the UK economy, but also long-term challenges, working from home and the online onslaught on brick and mortar retailers. Analysts will look for trends in the data on new rental activity, vacancies and the rent roll, as well as operating expenses when they assess the numbers, not least as they will drive the 2 headline figures by which these results will be judged. The first is net asset value per share, 30.44p a year ago and 31.49p at the end of 2024. And the second is the dividend, 25p a share at the first half stage last year, and analysts have penciled in a 2% increase for the whole of 2025 to just under 82p a share. I hope that you and your families are all keeping well. Thank you for watching, and I look forward to seeing you again next time.